Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on trading with over 190k reputation points. In today's video, I will be giving you the ultimate candlestick patterns trading course. Now, why will this video be different from all the others that you have seen online? Because not only we will be speaking about the basics of candlestick patterns, so designed for beginner traders, but then we will also shift to advanced topics that you have not seen anywhere else, but are of key importance when it comes to the Forex market that you must know. So without further ado, let's get straight into it. Okay, so we will be starting here from the basics. Now, even though you might already know these concepts, I still suggest that you don't skip immediately to the advanced part because you will have a better view of everything that I want to illustrate when it comes to candlestick charts. So you will have a clear understanding if you watch the video from beginning to end, okay? Now, obviously, when you're looking at any specific chart, you will see that a candlestick chart gives you limited information on how the market has actually been behaving, how the price has actually been moving. In fact, when you look at a chart, you will simply see a series of candlesticks which indicate how price has been behaving in that specific time frame. Okay, so you will see a series of red and green candles. Now, why do I say that it gives you limited information? Because if you see a candle, okay, and if you will either have a green candle or a red candle. A green candle will look something like this. A red candle will definitely look like something like this. Now, why do I say it's limited information that it's giving you? It's giving you limited information, but at the same time, useful information, which is why it's the most used charting tool in the world. That is because it will only show you the opening price. So where the market has started trading in that specific time frame. For example, here we are on the weekly. You will only see how the week has opened, okay? The open price, which is the low of the body. This is the body of the candle. And the low is where that specific week, in this case, since we are in a weekly chart, has started. Then it will give you the close, which is the high of the body, which is very, very important. Closes are incredibly and extremely important, and that is why I have them in red, because later when we go to the advanced topics, we will be speaking about closes. And then you will have the high, which is the high of the wick, so the highest level that the price has touched in that specific week, and you will have the low, so the lowest level that the price has touched in that specific week, okay? Same thing for a red candle. You will have the open, which in this case will be the high of the body, so opposite to a green candle. You will have the close, which is the low of the body. You will have the high, which as for a green candle will be the high of the wick, and you'll have the low, which is here, which as for the case of the green candle is the lowest level that the price has touched in that specific period. So as you can see, we have very limited information because we don't know how the market has moved when it was actually creating this candle. Because even though, for example, in the weekly, you will see a candle like this, you don't know what happened in the middle, because inside of here, the market could have made hundreds of moves, okay, and still closed here and opened here. But you don't know how the price has moved during the week to then create this candle. But for that, it's not a problem, because that is why we have multi-time frame analysis, which is the topic for another video, because you can obviously shift time frame and go on lower time frames to see how the price has actually moved inside of here. But if we're looking only at one specific time frame, we have a limited information, okay, which is the high, close, the open, and the low. Same thing for a red candle. Now, these are the basics. You must know these things. This is the wick. This is the body of the candle, and this is the wick. Same thing here. This is the wick, this is the body of the candle, and this is the wick. You must know these things, okay? These are the basics of candlestick charts. However, which is the most important thing? The most important thing when it comes to candlestick formations and charts is not the classical candlestick formations, like for example, the morning star, and all like the pin bar and all those candlesticks that everybody is showing you. Why those are not important? Those are not important because they will depend on the closing times of the brokerages, okay? Let's say, for example, you're on a 4-hour chart. The exact same price action, just depending on the closing time of the broker, can have a body like this, okay? Or can simply be a doji, okay? So you can, a morning star, whatever you want to call it. Now, this is a big problem. Why is it a big problem? Because the same exact price action has given you two completely different signals, okay? I hope you understand this concept, because some brokerages, for example, let's say you have your usual time zone, it's midday, okay, in your time zone. Now, the broker on which you're looking at charts, so the broker that is providing the charts, can have completely different closing times. Some have the New York closing time and do 4-hour starting from that. Other brokerages will have different closing times for these candles. So candlestick charts will differ sometimes massively depending from a broker to another. So why you can't really rely on candlestick formations in the traditional sense? Because they can easily be used to manipulate you in positions that actually on other brokerages are completely different. So it is not an objective way of looking at charts. What you actually should be focusing on is how the movements of the market are creating the charts, because those cannot really lie. And even if they differ a bit from broker to broker, so from chart to chart, still the fundamental movement of the market, that will be exactly the same. Okay, you will not have big difference on that, because even the two brokerages that have the most distant closing times, still the price movement is the price movement. So you will not have the possibility to have such different chart, okay? That brings me to speaking about a little bit more advanced topics, which are the key elements that you have to extract from a candlestick chart, okay? So let's say here you have this green candle, which is the most important thing that you have to take out, the close, okay? The closes, those are extremely important because they give you the strongest levels of support and resistance in the market. So when you're looking at any kind of candlestick chart, what you want to know is where are the closes. Now, there is a trick to identify the closes. In fact, if you go here to the chart, you can switch from candlestick chart to line chart. Line charts will show you the closes. Every specific angle that you see here, okay, those are the closes that the market has on that specific time frame. In this case, we are on the weekly time frame. So what you will see are the weekly closes. For example, this one here, okay? Switching back to candles, what you can see is that this close here, which is the close of this red candle, we know that if we zoom in, we know that this is the close, right? We identified it here. For a red candle, when you have the body, the low of the body, that will be the close. So here I have put this horizontal ray exactly at the close of this candle. What we can easily see here is that when the market went and tested here this close, it immediately got rejected. So this is a pattern that the market loves to create over and over again. So when you see a red candle and then immediately a green candle, that is one of the most important patterns that you must memorize, okay? You see a low in the market, you want to identify the close of that red candle. That is how you use candlestick charts in this specific situation, which is one of the most common situations in the market, previous support, term resistance. You want to identify the close. The close here is the level that the market is supposed to go and test and then reject to the downside. You will see this pattern happening over and over again. Same thing for a bullish case scenario. Let me identify one for you when the market was in uptrend here. So you can clearly see, for example, that when the market was here, it was in this uptrend, it went, broke above the previous resistance turn support. Where is the close? Well, switching to a line chart, you can easily identify that the close was here, right? And in fact, we can see how the market went and stopped at the close and then got rejected to the upside, okay? That is the first most important candlestick chart that you must memorize, candlestick formation that you must memorize, okay? If you see a low or a high, you want to identify the close. You can either do it directly from this candlestick chart, or you can switch to a line chart, which will simplify things for you. The second most important candlestick chart that you must learn to identify, and that cannot really be manipulated from closing times of the brokerages, is this formation here. When you see a candle which has a body, which is green, and a very long wick on the top, you do expect the next candle to fill in the wick. There's a high probability that the next candle is going to fill in the wick. It obviously will not be every time, but there is a high probability. It will not be every time that the market rejects previous support and resistance, but there is a high probability. And this will help you to either develop a strategy or anyway find more confluence for your trades. Same thing here. If you have a red candle, so with a very big red body, but an even bigger wick to the downside, what you expect is for the next candle to fill in the wick. Now, if you're asking yourself, okay, but why this cannot be manipulated by different closing times of brokerages? Well, the answer to that is actually pretty simple. The reason is that if you see a candle like this, for example, on the weekly time frame, since we currently are on the weekly time frame, there's a very high probability that the reason for which the market created such candle is because on the lower time frames, for example, on the daily time frame, you will actually have an impulse and correction, in which the correction that you have on the lower time frame, for example, in this case on the daily, is exactly the wick that you see here on the weekly time frame. Why am I saying this? Because remember, when the market creates a move to the upside and then retraces and creates the close of the candle, that becomes the wick, okay? So in this case, the retracement is exactly the wick. That is how candlestick formations get created. You have the correction, the market creates the wick. After an impulse and correction, which is the most basic pattern in the market, you want to see the continuation, right? For the creation of an uptrend, which is a series of higher highs and higher lows. So that is why you expect bullish continuation. Same thing in a bearish case, in which you have the impulse to the downside followed by the correction, in which the correction is exactly the wick that we see here from a candlestick formation perspective, after which you expect a continuation and the development of a downtrend, which is a series of lower lows and lower highs, okay? Very, very important to point this out. So going to a chart, how can I show you a live example of this? Well, let me identify one quickly. Okay, this one here, for example. What we can see here is that you have this candle here. Let me zoom it in, which will be easier. So if we zoom in, we can see that we have this candle here, okay? Candle with a green body and a very long wick, indicating a specific movement of the price. If we go here, we can see that that is exactly basically the example that we had at this level. Now, I want to show you, just for the sake of illustrating this, how this looks actually on lower time frames. Because if you remember, I just explained that the reason for which this pattern is formed and the reason for which we expect the next one to fill in the wick is because you have a high probability that you will have an impulse and correction on lower time frames, in which the correction is exactly this wick. Right? So if I switch now, for example, on a lower time frame, for example, in daily, I'm supposed to see that exact movement. I'm supposed to see an impulse and correction. So going down to daily, we can in fact see that we have an impulse and correction. In this case, also potentially creating this inverted head and shoulders with the left shoulder here, head here, and right shoulder here. But that is basically for another video. And in fact, if we switch back to candles, what we can see is that the next candles fill in that wick, creating the continuation to the upside, therefore fueling an uptrend from a daily perspective, so the creation of higher highs and higher lows, which, if you remember, is exactly what I was explaining a few minutes ago. If you don't remember, I can understand because this is starting to get a bit advanced, so I suggest to rewatch everything, okay? I always suggest to rewatch the videos multiple times, because if you watch them many times, the next time you will grab more specifics of what I'm trying to explain. And this happens, for example, also with films. Like if you're watching a film the first time, the second time, third time that you watch it, you will start to notice many things that the first time you haven't noticed. I'm sure that this has happened to you because it happens to me all the time. So switching back to candles and to real time, going back to the weekly time frame, which is where everything that I was explaining was. Okay. Now, I have explained the two most important things that you have to extract from candlestick charts when you are analyzing the market, which are the closes and the patterns that you need to know. The patterns that you need to know when it comes specifically to candlestick formations are closes when it comes to red-green or green-red, so the lows, or the highs, as we have also identified here, where you have green-red, and then the market breaks to the upside. Same thing when you have red-green, and then the market breaks to the downside. That is a very strong level that the market is supposed to test and reject. And the specific formations here, which are the only ones, in my opinion, that can't really be manipulated by different closing times of the brokers. And that is a very, very common way that manipulators of the market can create a specific pattern to then just manipulate traders. Why would they do that? For example, let me give you just this last example and then we're going to end the video, but this is a very important one. Now, you know, the most famous pattern is probably the pin bar, okay? How many pin bar trading strategies have you watched? Countless, right? Now, when you have a pin bar, okay, let's say a bullish pin bar, everybody will tell you, okay, you have a pin bar. What you could do is, for example, place a buy order with a stop loss below the low and take profit at 2 times or something like that, okay? However, it's very, very important to notice that there is a high chance that the market actually will melt to the downside, go below the low, stop out, and then reject to the upside. So that is why, for example, a pin bar can actually look on the exact same pair, exact same time frame, simply different closing time, like something like this, okay? It can look like a completely different pattern, for example, still green, but like this. And if it looks like this, you will not be looking for that pin bar, right? You will probably be looking, if then the next candle is showing something like this, you will probably actually be looking for a short instead of a long, which in this case you would be right. So it's clearly not an objective way of looking at the market because it will depend on the different closing times of the brokerages. And you can go and test this out yourself on any chart, looking at different brokerages, and you will see substantial differences on the charts depending on the closing times, specifically on the 4-hour time frame. Now, if you don't know what I'm speaking about when I say shift of market environment and valid entries, that is all part of the mentorship program, which you can now access completely for free. The link is in the description and I really suggest that you go and check it out. Also, if you enjoyed the video, make sure that you smash that like and comment below. It really does support the creation of more free analysis education and updates for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.